Hello everyone. We are starting out our practice session on cash flow statement. Today is Wednesday, December 8th. New Year holiday is coming. Hopefully we will do a good practice today. Let me know if we have any troubles with the sound or with video quality. Let me do a few quick checks. So if you think your video quality is not sufficient, you can try adjusting video quality to 720p. With 720p, it should be better. It should be okay with that level of quality. So let me leave it here. Let me transfer it to that window. Okay, so let's start. Let's start with some general understanding of what cash flow statement is and why do we need it. The main need in cash flow statement comes from the fact that cash is actually more important to average enterprise. Cash is more important than income. If you earn an income and do not generate cash, you are actually working against yourself, and sooner or later you will run out of cash and you will have to go to the bank or attract capital in any other way. And most entity investors are interested in your cash movement and future cash flows, not in your future income generating activity if that activity doesn't generate cash. So cash is pretty important, and cash flow statement is a part of financial reporting packages under IFRS and under US GAAP. So we figure out cash flow statement is very important. Let's now take a look at the structure of cash flow statement. For that reasons, let's open financial statements of Apple. And let's go to their consolidated statement of cash flow. In consolidated statement of cash flow prepared under US GAAP, you will have to show cash flows from 3 different types of activities: operating activities, investing activities, and financing activities. So investing activities, cash flow from investing activities should show your purchase or disposal of your operating fixed assets, or your purchase and disposal of various investments. In your financing activities, you will show your cash flows with your lenders, with whoever is borrowing you money, or if you repay the money to creditors or to investors. A relationship with shareholders like dividends or repayment of capital like share buybacks will also show up here. Let's zoom in a bit. So you see, in financing activities we have proceeds from issuance of common stock, payments for taxes related to net share settlement of equity awards, so basically some stock-based comps gas here, but only a tax part, payments for dividends and dividends equivalents, so dividends go here, repurchases of common stock go here, proceeds from issuance of debt go here. And here in investing activities we have marketable securities, proceeds from maturities of marketable securities, sales of marketable securities, and payments for acquisition of property, plant and equipment, and few other smaller items. So numbers for Apple are huge. All of these are in millions. So basically Apple traded like hundreds of millions of marketable securities. And didn't acquire actually much of assets, only 11 billions. And cash flow from operating activities was huge, $100 billion. So Apple is a pretty good company, pretty solid company. And operating activities is whatever results from your operations, which is not included in financing activities and investing activities. And for operating activities, there is two ways. To prepare that according to the US GAAP accounting standards. Most of the public companies use indirect approach to operating cash flows. So indirect approach is the one which starts with net income, and then you adjust net income by non-cash items, adjustments to reconcile net income to cash generated by operating activities, so non-cash items, and then you have changes in operating assets and liabilities. So basically, if you generated income by selling on accounts receivable and no cash was collected, so you will have some net income, but you will adjust net income through accounts receivable, and at the end of the day you will have zero in cash generated by operating activities if you generated all of your cash by selling on credit. The other method of cash flow is direct operating cash flow. Let me open it here. So we have it in the working file. Let me share the link. Okay, so here is the working file. So another method of presentation is by direct method, and it actually just lists different types of cash flows, like cash collected from customers, interest and dividends receipt, other operating cash receipts, cash paid to employees and other suppliers of goods or services, including suppliers of insurance, advertising, and so on, interest paid, income taxes paid, other operating cash payments, if any. Let me know if you have any questions concerning direct or indirect method of cash flow presentation. So basically these are two different methods, but they should result in the same total operating cash flow. So if you prepare the same direct operating cash flow for Apple, you will get the same result. The result should be the same. And investing and financing activities related to either direct or indirect method, they should also look the same, absolutely the same. And at the bottom of cash flow, you will have let's see. So they have here cash equivalents and restricted cash beginning balances. So that is a beginning balance, which should equal your previous period. No, not for quarters. So there is a beginning period. There is a decrease in cash and cash equivalents. 93. Let's see, 3 billion, almost 4 billion decrease. That decrease is just a total of 93 billion outflow, 14 billion outflow, and 104 billion outflow. So that is just a sum of three types of cash flows. And we have $35 billion at the end as a result, as a move from 39 less 3 equals 35. 39 less 4 equals 35. And we also have a supplemental cash flow disclosure. And that's for indirect method. So we show cash paid for income taxes as a supplemental information, and we have cash paid for interest, and that's all for Apple. But if we take a look at AMC, a cinema chain with a lot of cash flow issues, you will find out that they also have like interest and income taxes, and they also have a non-cash activities, some non-cash investments. And if we take a look at cash flow guidance, let's see if I can share the link with you. Yeah, here it is. I share that on every stream. Just you have it. It is a standard requirement to show non-cash investing and financing activities. And here is a list of several items. A few which we may be aware of are acquiring productive assets by assuming directly related liabilities, obtaining an asset by entering into finance lease, or converting debt to equity. So these are like non-cash financing and investment activities. Let me open Apple. So whatever we see here in investing activities and in financing activities should be actual cash movements. And if we have some non-cash investing activities or non-cash financing activities, we should disclose these all as a supplemental information here. Okay, so now let's move to our homework. Let's move to our homework file. So this is already homework 5. Let me share the link. Okay, so we have all previous homeworks described here in a short. And let's see what we have. We have to create 5 non-cash entries for our business and map them to period 1. So basically we will be dissecting how do we reflect a non-cash items in our cash flow statements. As you might guess, if we use a direct method of cash flows, of operating cash flow, we won't see any impact from non-cash items. But in our indirect method, we will have to face some choices here, because most of these non-cash movements will change our income statement, and will require us to adjust our operating cash flow somehow. Okay, so let's go back here. Okay, so not this. Let me close this. I'll need. Just give me a second. Oh, I actually have a link in the homework. It's a link to previous practice session. Cash flow. Okay. So that that is a session where we prepared cash flow by direct method for period 1 and cash flow by indirect method. Let's do a quick recap of what we did. So we went to transaction list and we mapped each transaction to cash flow statements. So we basically went through entry one by one, and whenever we see debit cash or credit cash, we mapped it. We mapped it to either operating activities or to investing activities. And sometimes it's not a straightforward operation. You can't always get this right. For example, we faced one choice here. What do we do with when we acquired a building on a mortgage and we paid only 50,000 cash, but building was 200K? If it's a third-party financing, we reflect it as a gross. And if it's not a third-party financing, we reflect it as a net. So let's see. Cash equity. So that is owner contribution, proceeds from issue of shares. Let's see what we have in our direct and indirect method. Okay, we have it here, and here for indirect cash flow, we can basically take all the numbers from direct cash flow method, because direct cash flow and indirect cash flow will be the same for investing and financing activities. Hi Ekaterina, thanks for your question. I believe QuickBooks has its own cash flow statements, QuickBooks Online. However, I'm not sure that it will reflect all the statements, all the entries in accordance with US GAAP. So basically, you kind of have, if you want to prepare, if you really have a need to prepare cash flow statements in accordance with US GAAP, you need to kind of have some of your information, some of supplemental information in spreadsheet or somewhere else. It's really we will try to challenge QuickBooks Online today to see if it is right. Let me just finish the formula part for that. Oh, I already did some. Okay, let's see what happens. What is that? Okay. Okay, building acquisition. Equipment acquisition and third party. Why am I not getting the numbers? B. Okay, I see now. So it should go as far as here. Okay, I will just move it here. Okay, total investing activities. So we invested quite a bit of money. Okay. So everything looks good here. Let's start with experimenting. So this is previous homework. Okay, accounts receivable provision. Let's see if we have accounts receivable in the first place in our transaction list. Okay, we have some other mortgage, prepaid mortgage, revenue. Okay, so we got some here. Just we need to make sure that let's see where our period is. Okay, it's period 1. Yeah, so we did some non-cash. And I think we reflected everything up to here. So let's add some rows here. Okay. At the period end, we realized that some of our AR are uncollectible. 2000. Let me see if we have such accounts receivable at all. Accounts receivable trade. Okay, period 1, 5000. Okay, so we have debit, we have credit. In the debit side, we will go through accounts receivable allowance. Okay, so we will debit accounts receivable allowance, trial balance, and sorry, I am wrong here. We should credit accounts receivable allowance. Okay, we should debit let's call it accounts receivable provision. We need to create separate, and I don't really know where to reflect it. Let's put it into cost of products first, or cost of services. Doesn't matter much. Let's see what we sold on credit. We sold services on credit. Okay, and so here we will use accounts receivable provision expense. $2,000. $2,000. Okay, obviously we need to map it to period 1 to see it in our there is no mapping to the direct method cash flow. Let's see what happened in the direct method. Let me hide it. Okay, so we have 16,200 outflow from the operating activity as it was in the direct method. In the indirect method, okay, I know what happened. I just didn't update the formula here. Okay, indirect method. So our accounts receivable provision reflected in our net income, and we didn't adjust it for it anywhere else. So it reflected in total operating cash flow. And now two our cash flows are different. Let's make here a note. Operating cash flow under Direct Method. And let's get it from here. So you see, our numbers are different. We can even calculate the difference here. Oops. $2,000. Let me highlight it so that we know that it's just some note. So now we need to adjust our situation. We got change, decrease, increase in trade receivables, 5,000, and it was from mapping. Let's see what we have in that mapping. We got it from trial balance, and we didn't map allowance. If I map allowance, let's see what the effect will be. So if I map allowance, if I include allowance into the change in trade receivables, I will actually kind of reconcile that stuff, and everything will match again. But allowance is actually non-cash item, so let's go make some checks in the guidance regarding allowance. So what we need to figure out in the guidance is whether we include allowance in the change in trade and other receivables, or if we reflect it in the non-cash item. Okay, there is too much mentioning of the provision here. Let's go check a template first. A sample. Amortization of discounts, gain loss on extinguishment, depreciation, amortization, impairment of assets, provision for bad debt expense. 673. Classification of cash flows. Let's try to search it by the word bad, maybe bad debt. Yeah, so basically the only Q in the guidance which we have is just to show it as a non-cash items. So we we actually have to change our presentation here. So if we go back here, and if we go back here, and we actually we do not map allowance here. Let's map allowance in here. Let's even call it bad debt expense to make it more clear, and let's map it to cash flow this way, and let's reflect it in here. Okay, bad debt expense 2000. So we are basically adding that change here. Now let's try to find out what cash flow impact will we have if something change about bad debt expense. Allowance, I actually mean that accounts receivable go bad, like go to collection. We do not expect the customer to pay it, so accounts receivable become uncollectible, and we have to somehow discount it or to write it off, and we usually do that through bad debt expense and through accounts for allowance for accounts receivable. Okay, so we did one, and it was it was a non-cash item. It shouldn't be included in the change, it should be included in the non-cash item. Same here, we have inventory obsolescence impairment. And I do not actually remember if we do the same with inventory NRV expense. Okay, let's do items one by one. So now we did period 1, we did period 1 inventory accounts receivable allowance. Period 1, period 1, period 1. Now, if we have unexpectedly we reversed 2000 of AR, let's do it with 1000. So basically, if whatever happens to the allowance in the future, if we reverse it and it reflects in the income statement in this period or in the next period, it will go to the same accounts. So basically our net income will improve a bit for that 1,000, and our bad debt expense will adjustment for bad debt expense will change for 1,000, and our cash flows will reconcile again. So what are the lessons from here? So first lessons, in the trade receivable, you want to look at the gross numbers. You want to look at the gross numbers in the change in trade accounts receivable. And let's make a note that under direct method we have a header, cash collected from customers. So our cash collected from customers will be our, let's do it this way, AR opening revenue cash we do that form of roll forward, and let's add allowance. So in our situation, let's use everything gross now. So we have that amount of trade receivables, 0 in period 1. Our revenue for the period was, let's see, 11,000. Okay, we will have to keep revenue as a debit here. So our revenue increases our AR. So our cash receipt, we will calculate that number. So that will be a balancing number. We have some information about allowance. Allowance decreases our accounts receivable, and we have information about receivable. Let's use the number after allowance. We just need to make sure that we use everything consistently. So we need to select such cash receipt that will make that equation to balance. So we have 10,000 here. So cash receipt is probably 6,000. So that way, let's do check. Okay, everything checks out. Cash receipt 6,000, and as you can see, that is what exactly we have in the cash collected from customers. So that is a second way to check the entry. And when we look at indirect cash flow method, we use change in gross receivables here, and whatever goes through income statement, we use that as a non-cash adjustment. Hopefully, is it Ekaterina, is it clear what I called an allowance? So basically, first type of check what we can do is to check, to compare between indirect method and direct method. And second type of check that we can do is to make like a roll forward and calculate what cash should be involved. And the third method which we can use is just go through a transactions list one by one and pick up the transactions. So let's see what I have here. Inventory NRV allowance. I thought, so with NRV I will have to spend some time here, because here we have inventory obsolescence impairment, and obsolescence is not the same thing as NRV. And I remember, let's see if we say anything about that. Net realizable. On what page? Okay. Okay, so basically cash flow statement guidance here doesn't tell us anything about net realizable value of inventory. So net realizable value is basically a non-cash item. It is non-cash impairment of inventory included into cash of cost of sales usually, or it may be a separate line on the income statement. Let's see, just give me a couple of seconds to find any other guidance. So let's start with example first. So transaction list, trial balance. Let's see if we have inventories. Yeah, we have inventories, and let's add inventory. And also let's add, okay, next to bad debt expense. Let's see. Okay, inventory NRV expense. Okay. So I'm booking 1000 of inventory expense. Basically with NRV and inventory, the situation will look similar to accounts receivable. Let's see. 1000 minus 1000. Let's do 3000. Just not to make it 1000 everywhere. So let's see if it reflected. Okay, it hasn't reflected in income statement yet because I didn't map it to the period. Okay, so now we have a 3000 difference again, and now we have a choice to either reflect it as part of inventory change. So if I map it here, everything will reconcile back. Or I can go back here and book inventory NRV expense. And I will add it to here. Okay, impairment doesn't count. Trial balance, inventory, NRV expense. So that is something I want to check. I'm certain that in the company I worked for, inventory was impaired due to NRV, and it was reflected as a reconciling item here. So as you see, all our numbers did reconcile, and we booked it as a non-cash movement. So inventory provision is a non-cash movement, and it kind of has a similar substance as bad debt expense. So I don't really know why they didn't list it here. I'm certain that I've seen it in different companies in the reconciling item, but it is what it is. We have inventory obsolescence provision here, inventory obsolescence impairment. So it says 673. Let's see what we have in 673 for operating activities. Okay, it doesn't list anything related to inventory NRV adjustments. So let's keep it here this way, and I will add a question. I will add a question about okay. Now we have depreciation of fixed assets. With depreciation, it should be, we actually already did depreciation here. So depreciation is clearly a non-cash expense, and trial balance, transactions list. So we had it. Let's see where we have it. Yeah, so we depreciated some equipment for $200. 5 years, straight line basis, zero scrap cost. Let's see what equipment do we have here. Let's say we're depreciating all our equipment for 5 years. Then I will go at, I will basically go to the trial balance and see what I have for period 1 here. Buildings, equipment. Okay, buildings plus equipment. And I will calculate monthly depreciation. So I divide it by 5 and then divide it by 12. So I got 35,500. Let's see if it is, yeah, it has reflected in the cash flow, and it is a non-cash, so it has no impact on the direct method, and our operating cash flow is still it's still correct. Okay, let's see if we got any questions. At TB we have 2 depreciation. Okay, we have 2 depreciation accounts. Let's do you mean 2 depreciation accounts in balance sheet or in income statement? We have accumulated depreciation equipment, and in the income statement we have depreciation expense. So these are two different accounts. When we make an entry for depreciation, we debit the expense account, the one in the income statement, and we credit accumulated depreciation. So we accumulate depreciation under that header. Were you asking about these two? So the one is a balance sheet account and the other one is income statement account. Oh, yeah, you probably meant this one. Let's see. Okay, we can ignore this one. So I didn't map anything to here. I mapped all the stuff to depreciation expense equipment. My checks are all 0. Yeah, I deleted this one. You can have several depreciation accounts for different types of fixed assets if you really need that for your financials. Okay, let's take a look. Is depreciation clear? Is the impact on cash flow of depreciation clear? Depreciation, so you basically add back depreciation to your net income to come up with your operating cash flow. Cash, it's actually currently it's flow, but we can also say if it's negative it would be outflow. Okay, so depreciation was here, and then we will do a bit of an exercise on a property, plant and equipment item. And the reason I'm doing that, let's go back here. If I'm not sure if I can find it. I've got a question. I saw a question in one of the Facebook groups about acquisition of fixed assets, about reflection of the cash outflow on fixed assets, and I'm now looking for it. Where did I respond it? Where did I respond? Okay. So that was in one of Facebook group, and the text was in Russian, and there was a link to the formula. So that is a post, but it's in Russian, and that is a link to ACCA. Okay, the link is too long. I don't know. So basically the link is in the post. I cannot send you the link. Oh, I can probably try to do it that way. Let's see if it will work. Okay. And on that link, we are interested in calculation of cash flows for PP&D in the situation where we have disposals. So let's take a look on our investing activities. So we have building acquisition, we have equipment acquisition, we have equipment acquisition, third-party finance. Okay, so now under indirect, so we obtain that number by tracing every PP&D transaction in our transaction list. But that information is usually not available in a big company. If you have a big company which is consolidated company, you will have a much more complicated situation. And you usually need to extract that information from your balance sheet. Let's try to run a few scenarios. So first scenario, no, all PP&D was acquired by cash. Opening PP&D. And we know from the balance sheet, we know opening PP&D and we know closing PP&D. And the balancing will be cash paid for PP&D. So zero came from let's see, so from these numbers, no, we do not take into account accumulated depreciation and we got some land here. And this will be our closing amount. So gross PP&D. No, do not take depreciation. 213,000. Okay, so our cash paid for PP&D will be just all of that. Okay, so let's run second scenario. Let's try to think of one. Let's say we use net book value of PP&D, and depreciation is involved. So basically our beginning is the same, 0. Our closing will be the number which we take from our balance sheet. Let's see. Oh, my balance sheet is not done. That is very bad. Okay, so I will just add depreciation to that one. Okay. Then I have to add depreciation here. And depreciation will decrease the value of my PP&D. So I will take a credit for depreciation. Trial balance. And depreciation is here. So now to figure out the number, I will take that amount and deduct whatever is above it. So basically we incorporated depreciation in that calculation. now we want to make an additional step, and that step would be disposal. But first, 3 in situation 2, we incorporate disposal of PP&D. I think I will have to make a paste value here. Values only. Okay, let's go and dispose of some PP&D item. Transactions list, period 1. Okay, what equipment did we have here? We had... Okay, we just expand this one. We have one equipment for 12,000. We disposed of 12K worth of equipment for let's say we did a gain here for 14K. So what do we do? So first we credit an equipment. Then we debit cash. Let's assume it was a cash transaction. We debit. So that would be minus 12,000. Cash would be 14,000. And we calculated depreciation for that equipment. So we need to actually remove accumulated depreciation related to that equipment from our trial balance. Let's see what account did we have here. Accumulated depreciation equipment. And the calculation was that amount divided by 5 divided by 12. 200. If you remember, here we calculated depreciation for like all of our fixed assets. We just bulked it all together. And here we deduct only the one related to that piece, that 12,000 of equipment. And the last step will be to recognize gain loss on disposal of assets. And that will be just the balancing number for all of that. Let's try to calculate it this way. Okay, we earned $2,200 on that disposal. Now, let's think what we will see in the direct cash flow statement. Okay, let's book it to the period first, and then let's add a disposal account here. Transaction list, gain loss on disposal of assets. Let's say it's other operating expense. Okay, so our trial balance balances, everything looks fine. The transaction clearly has a cash impact, and that cash impact will be a cash acquisition it's actually disposition of property, plant, and equipment. Let's see. Does Apple report it on a gross or net basis? Payments for acquisitions, purchases, proceeds. Okay, let's call it proceeds from sale of equipment. Okay, so we mapped it to the period, we mapped it to direct cash flow. Let's cash flow direct investing. So that's investing activity. Let's add it here. Okay. I'll also need to add it here and make sure that it's mapped. Okay. So that's what our number should be. And now that what let's see, it just shouldn't be negative, it should be proceeds. Okay, so that's the right number for our acquisitions of fixed assets, and that's the right number for proceeds from disposal of fixed assets. And we will only we're able to get these numbers because we have access to transaction list. Now let's try to do that on from the balance sheet perspective. So this one should also come from here. So now we will try to get that total fixed assets acquired using a roll forward model, roll forward method. So we have opening PP&D, which is 0, as we know. We have closing PP&D, and we use net book values. Let's go to trial balance and get our closing number for period 1. So all after depreciation and disposals. Okay. So what movements do we know? What do we know about our movements? We know that we had depreciation, and that depreciation decreases our net book value. Let's add that's all about net book value. Okay, so depreciation decreases. Now we have disposals. Disposals of fixed assets. And for that disposal, we kind of have to know that number. Let's think about it. And let's add a bit of complication here. net book value. So we will act in three different dimensions here: cost, net book value, accumulated. Okay, I had some pictures here, but they do not work anymore. Okay. So for cost, let's see what we have for cost. So opening is 0, obviously. For cost, we do not need depreciation. For disposals, we know that we disposed of 14,000. What? We disposed of 14,000. And we know that our closing, let me remove this. And we know that our cost for PP&D at the end of the period, it was 201,000. And now we need to calculate cash paid for PP&D. If we have all cost data, and the most important one will be this one. If we have access to that number, we can figure out the rest. So that will be this minus sum of everything else. Okay, 215,000. Let's see. I have a different number here. What should be the reason? $500. Third party equipment. Oh, it was actually probably 77. It was 12,000. The disposal was 12,000 this way. 213,000. So I disposed of a cost, and whatever is left was cash paid. How do I have 12,100 here? Let me see. Okay, line 56. Line 56. Yeah, that was one of examples where we have a trade finance, which is a non-cash acquisition of property, plant and equipment. So basically we have to account for that as well in our roll forward. Cash flow, indirect. Okay, let's call it non-cash acquisition of PP&D. And for non-cash acquisition, let's see. So we acquired 500 total, and non-cash component was 400. Let's see if I can get it from here. So that is payable to seller, and it should be negative. 12,600. Let's see what I have here. 212,000 and $1,600. So finally, so we got that number from our transactions, and we got that number from our transactions. Now, what do we do if we use net book value and we have accumulated depreciation? So it was obviously 0 here. Accumulated depreciation increased with, do we keep it negative or positive? Let's keep it negative. It's a credit balance anyway. So accumulated depreciation increased here. But we got, let's see what we have for period end accumulated depreciation. And we got 301.50. And the change was due to disposals. So we basically calculate disposals as a balancing number. Let's see. Okay, this way. We calculate it this way. Now let's use gain. Okay. So for non-cash acquisition of PP&D, we still have an impact from that on NBV. We still have an impact from that on NBV. Gain on disposals we can take from trial balance or income statement. 2,000. And that gain, let me think. So I still have to know a net book value. I have gain and I have proceeds from disposals of PP&D. So my proceeds were 14,000. My proceeds were 14,000. And they kind of in the transaction list, we depreciate our fixed assets over 5 years and each year is 12 months. So I got a question about why we divide depreciation by 5. And I divide by 5 and then by 12. Let's call it comment depreciated over 5 years by 12 months or 60 months. Okay, let's come back here. Proceeds from disposals. So we know that we have 14,000 of proceeds, and that number is also from our transaction list. Let's go find it here. 14,000, and that 14,000, so gain should probably be positive. 14,000 should probably be negative. So non-cash. What am I missing here? What am I missing here? Okay. My formula is just not right. 43. Okay. So answering the question, what do we need? What do we need to prepare a roll forward, PP&D roll forward? If we use a cost items, we will have to know what was the cost of PP&D disposed and what was a non-cash acquisition of PP&D. And that's what we get. Not available directly from income statement or balance sheet. Let's see. As you can see, after we booked PP&D disposal with a gain, that gain reflected in our net income. And now our operating cash flow is different from direct method cash flow again. And if we go to the guidance, let's take a look overview. Okay, it is a reconciling item, gain or loss on disposal of property, plant and equipment. Let's go back here and let's add it here, and let's map it here. Oops. And let's map it here, and let's I'm still off. Let me think what the reason might be for that. Loss gain on disposal of property, plant and equipment. So we did a disposal and it reflected in here, and I'm getting 17,000. Okay. Oh, we had some item here. Yeah. Probably. Oh, thank you. We had non-cash interests there. Thank you. You are very attentive to details. Okay, let's finish up with that. Let's finish up with that. Okay, so everything matches again. So basically, to calculate these numbers, to calculate, let's see, these numbers, acquisition of fixed assets. If we got disposals, we will have to know our non-cash acquisition of property, plant, and equipment, and that non-cash acquisition, it actually goes here, and we will highlight it by yellow. We will have to know that. So let's highlight it by green, I would say. Oh, not okay. Let it be very dark green. And we have to know that information regardless, because we have to show it in our cash flow. So we have to show our proceeds from sale of equipment here. And we have to show non-cash financing activity here. And because we have to know these two, it is somewhat easier for us to calculate everything through net book value. And for gain, I believe no. So basically, that's why NBV is probably a preferred way to calculate anything, because we need these numbers for our cash flow statement regardless. We need to get them from our transactions list or transaction detail. And the 12,000 cost of disposal of fixed assets, that's like an extra information if we need to double check. As you can see, that's a balancing number, and it is the same if we go through the costs, and it is the same if we go through net book value. So we already done 1.5 hours of practice. Let me see where do we end up. And seller financing. So we already kind of covered it with these $400 seller financing. So that seller financing transaction was reviewed a bit earlier today. And proceeds from sale, interest paid, equipment, seller financed equipment acquisition. So that's part of the homework is here. You can find it in the standard. Let's see. not software revenue. In the standards, we have non-cash investing and financing activity in the guidance. And if you scroll down a bit, you will find examples where they discuss when the acquisition of property, plant, and equipment results from non-cash transaction and when it results from a cash transaction. So hopefully it made the cash flow statements a bit clearer for you. Maybe you understand that most of the items in the cash flow statements require like double check or triple check, and you only can check yourself if you know against what you are making a check. You have to know what your numbers are, and that usually you are not able to get a direct method of cash flows, so you have to make these roll forwards to figure out what your correct number is, like through cost or net book value. Thank you for coming. See you probably tomorrow. I will ask in the chat if anyone needs a Russian session tomorrow, or on Saturday for an English session where we will consider other tasks from the homework. Thank you and good night.